Welcome to another Talk Tickers style deep dive, where we are breaking down corporate earnings directly for you, the retail investor.
Yeah, and we are sticking to the core mission today, which means we're going data forward, keeping it plain language, and definitely staying highly opinionated.
Oh, always opinionated. And we want to give you actionable takeaways, not just, a boring summary.
Right, because nobody needs another textbook reading of an income statement.
Exactly. So today, our source material is the Q2 2026 earnings call from Eaton Corporation. Ticker symbol is ETN.
And this call was led by their CEO, Paulo Ruiz, who is actually just celebrating his one-year anniversary in the role, along with CFO Dave Foster.
Yeah, and look, usually when you pull up a stock chart for a 112-year-old industrial company, you expect something pretty sleepy.
You expect a freight train, right. Slow, steady, maybe a nice, reliable dividend.
Right, just heavy metal moving down the tracks at the pace of global GDP.
You definitely do not expect a rocket ship doing barrel rolls.
But that is exactly what we have here. Eaton is behaving like a Silicon Valley tech darling right now, not a company that bends metal and makes electrical switchgear.
It's honestly wild to see an industrial stock chart look like a hyper-growth software company.
It really is. So we're going to figure out exactly why by running it through our signature four-part Talk Tickers breakdown.
Which means we'll hit the headline numbers, the story behind those numbers, what management is guiding for the future, and of course, the bottom line.
Right, so let's just jump right into part one, the headline numbers. And wow, the raw print for Q2 was just massive.
Yeah. Adjusted earnings per share, or EPS, came in at a record $3.15.
Which is crazy because that beats the midpoint of their own guidance by a full 10 cents.
A massive beat. And it brings their first half EPS to a record $5.96.
And the revenue side is just as staggering. We're talking an $8.5 billion quarter.
Which represents 21% total revenue growth.
I just want to pause on that for a second because 21% top-line growth for a mega-cap, century-old industrial company, that's highly unusual, right?
Yeah. Oh, it's practically unheard of. I mean, in the traditional industrial sector, a fantastic quarter might be, 6% or 7% growth.
Right. And that's usually if there's a big macro cycle or an infrastructure bill or something.
Exactly. To see 21% implies that something structural has just fundamentally broken to the upside.
It feels like an offensive lineman suddenly running a 4.3-second 40-yard dash. Mm-hmm. It just doesn't compute.
That is a perfect analogy. You expect those numbers from a software as a service company scaling up, not a company manufacturing, medium voltage transformers.
So naturally, the question you have to ask is this just a temporary sugar rush, or has Eaton's baseline permanently shifted?
Well, to answer that, we have to split that top line growth into two buckets. You have total growth, which includes acquisitions, and organic growth.
Right, organic being just what their core existing businesses are doing on their own.
Exactly. And when you strip out the acquisitions, which management says were smart and are performing well, that accounts for about 7% of the growth.
Leaving a massive 14% as pure organic growth.
Which is the real story here. It proves their legacy products are just literally flying off the shelves.
And it gets even better if you exclude their mobility business, right?
Yeah, because mobility is going through some intentional structural changes right now. If you strip that out, organic growth was a blistering 16%.
A 16% core organic growth rate.
Uh-huh.
That is the engine driving this entire EPS beat.
It really is. It shows this isn't just financial engineering. They aren't just buying back shares to boost EPS. The fundamental demand for their physical products is exploding.
And it's translating directly into cash. Overall margins hit 23.1%, and operating cash flow was up 23% year over year.
The cash generation is just phenomenal. But before we get into the specific segments, we do need to clear up some noise.
Oh, right, the whole EPA and tariff refund rumor.
Yeah, if you were holding the stock going into earnings, you probably saw financial social media just completely panicking about this.
The rumor mill was in overdrive. People thought there was this massive one-time accounting trick inflating the numbers.
Or conversely, that a huge retroactive tariff bill was going to wipe out their margins entirely.
It got so bad that their investor relations desk was apparently flooded with calls. CFO Dave Foster actually had to address it right at the top of the call.
Which is annoying for management, but he handled it perfectly. He just immediately quantified it to shut down the algorithms and the panic.
So what was the actual unvarnished reality?
The total impact of the EPA refund in Q2 was exactly $2.8 million.
Wait, on an $8.5 billion revenue quarter?
Yep. It equates to less than a single cent of EPS.
Wow, so it is literally a rounding error on the balance sheet.
Completely immaterial.
Yeah.
And Foster confirmed it's fully baked into their guidance for the rest of the year, too.
So that 10-cent EPS beat was a purely operational victory. No accounting tricks, no tariff windfalls.
They earned every single penny just by manufacturing goods and shipping them out the door.
Okay, so the headline numbers are pristine. Let's move to part 2, the story behind the numbers, and look under the hood at the individual segments.
Because Eaton isn't just one big monolith. The growth across their different global divisions tells a very specific story.
We have to start with the absolute juggernaut, which is Electrical Americas.
Oh, absolutely. This segment alone posted 18% organic growth.
And margins hit 27.5%, which I think they said that was a 190 basis point jump sequentially from Q1.
Yeah, almost a full 2% jump in just one quarter, and their orders are up 41% on a rolling 12-month basis.
But the metric that really stood out was the book-to-bill ratio. It expanded to 1.3.
This is such a critical leading indicator. For anyone listening who isn't familiar, book-to-bill is the ultimate measure of future revenue visibility in manufacturing.
Right, so book is the new orders coming in, and bill is the stuff you've actually shipped and billed to the customer.
Exactly. So a ratio 1.0 means you're in equilibrium. You take in an order, you ship an order.
But 1.3 ratio in a segment this huge, I mean, that's a massive signal of swelling demand.
It means for every $1 of product they manage to push out the factory door, customers are immediately handing them $1.30 in new orders.
They are literally selling it 30% faster than they can physically make it.
Which mathematically guarantees future revenue. The backlog just keeps accumulating.
So they aren't guessing what 2027 looks like. Those orders are already sitting in the queue.
Exactly. But, Electrical Americas is historically their star player. The real shocker this quarter was the Electrical Global Division.
The surprise MVP, I mean, they matched the Americas with 18% organic growth.
And 27% total growth if you factor in the acquisitions, with margins sitting at a very healthy 24.5%.
But the backlog number there is what really broke my brain. Their order backlog is up 103%.
Yeah, and even if you strip out the acquisitions, the pure organic backlog in the global division is still up 54%.
And you were saying the geography of that growth is what really caught analysts off guard.
It completely defies traditional macroeconomic models right now. The EMEA region, so Europe, Middle East, and Africa, and the APAC region both grew by 20%.
I need you to translate that Europe number for me, because Europe has had a severe energy crisis, sluggish GDP, geopolitical instability.
Right. Germany's economy has been practically flatline.
Exactly. So in a heavy capital-intensive sector, how on earth does a legacy segment suddenly post 20% growth in a stagnant environment?
It's an incredible operational turnaround. CEO Paulo Ruiz specifically shouted out the EMA team. They aren't just riding a wave of grid modernization, they are actively stealing market share from entrenched European competitors.
Wow. So they're taking business away from the locals in a really tough environment.
Yeah, and Ruiz credited it to a structural agility they've instilled. He's purposefully pushing decision-making down to the frontline engineers and regional sales teams.
Oh, that makes so much sense. So if a European sales team needs to approve a custom engineering quote or a discount, they don't have to wait for 3 layers of management back in the U.S.
Exactly. They can close the deal before the competitor even finishes drafting their proposal.
Speed wins. In these complex, multi-million-dollar infrastructure bids, responsiveness can absolutely beat pure price.
It's a massive competitive advantage. Now, alongside those booming electrical segments, we should mention their stabilizers, aerospace and mobility.
Right. Aerospace posted 7% organic growth, hit a record Q2 segment profit, and margins expanded to 22.8%.
Plus, they had that defense acquisition, UltraPCS, which added 6 points of growth. And their book-to-bill in aerospace is a very healthy 1.2.
It's a beautiful, high-margin counterweight. Commercial OEM demand for new aircraft is strong, and the aftermarket is always lucrative.
It balances out the absolute hypergrowth on the electrical side. But then we have mobility, which actually declined 2% organically.
Now, normally seeing negative organic growth sets off major alarm bells for investors, but management seemed completely unfazed by this.
Because it was entirely intentional, Dave Foster explained they purposefully exited a specific low-margin business line in that division.
A strategic amputation, essentially.
Exactly. And if you exclude that intentional exit, the segment's growth was actually slightly positive.
And the proof that it was the right move is in the margins.
Yeah.
Right? Because despite the revenue dip, mobility margins actually increased by 90 basis points.
They cut the dead weight, sacrificed a little low-quality revenue, and immediately boosted their bottom line. Classic disciplined capital allocation.
Don't chase revenue just for the sake of revenue. I love that.
But look, while all these segments are doing well, there is one massive secular tailwind dragging all of this upward.
This is part 3, the data center megatrend. This is the core thesis for why Eaton is trading like a tech stock.
Yeah, let's look at the raw data here. Eaton's data center orders and revenue are up roughly 65% in the quarter.
65%. And what's the broader market growing at?
The underlying data center market is growing at roughly 23%.
So they are outpacing the baseline market growth by a multiple of nearly 3.
They're absorbing market share at an unprecedented scale. But the metric that really recontextualizes this entire opportunity is the backlog.
The total U.S. data center backlog has ballooned to 307 gigawatts.
Yeah. It is honestly hard for the human brain to comprehend what 307 gigawatts of electrical infrastructure looks like.
Well, a single gigawatt is roughly the output of a massive nuclear power plant, right?
Exactly. And Paulo Ruiz pointed out that over the previous several decades, encompassing the entire history of the data center industry.
A whole history? Like the dawn of the internet, smartphones, the shift to the cloud.
All of it. The total built capacity for all of that was only about 50 gigawatts.
That is insane.
Yeah.
So the backlog, sitting on paper right now, waiting to be built, is roughly 6 times the size of the entire historical market.
It completely shatters any historical precedent. Ruiz said this equates to 15 years of backlog at the projected 2025 build rates.
A 15-year runway, a restaurant fully booked out for 15 years.
But here's the crucial nuance he added. Only about 20% of this 307 gigawatt backlog is going to convert in the near term.
So when does the rest of it hit?
The vast majority of these deliveries will translate to deployment in 2028 and beyond.
And that 2028 timeline is why the market is re-rating Eaton's stock, isn't it?
Exactly. In typical industrial markets, investors are terrified of the cliff. You know, a boom year, companies overbuild, the market saturates, and then orders fall off a cliff.
Leaving you with idle factories and collapsing margins.
But because 80% of this specific build-out is scheduled for 2028 and beyond, the cliff just does not exist for Eaton. They have built-in revenue durability.
So let's translate that into actual dollars. What is Eaton's content per megawatt on these builds?
And analysts actually asked this during Q&A. Ruiz confirmed their content. So the transformers, breakers, cooling units required for every megawatt is hovering around $3.4 million.
Okay, let's run that math. 307 gigawatts is 307,000 megawatts.
Multiply that by $3.4 million per megawatt.
You are looking at a total addressable market exceeding $1 trillion just within the currently documented U.S. backlog.
Astronomical. And that assumes they only maintain their current product portfolio.
Which brings us to part 4, the 800-volt DC shift and their aggressive acquisition strategy.
Because Eaton is not just resting on legacy circuit breakers, they are actively rewriting the underlying physical architecture of the modern data center.
Yeah, this shift to 800-volt direct current, or DC, the engineering jargon gets pretty thick here. But why does a hyperscaler like Google or Microsoft care so intensely about this?
It all comes down to a metric called tokens per megawatt. It's basically a measure of computational efficiency.
Because these new AI chips, these GPUs, run incredibly hot and need massive blocks of power.
Right. And currently, most municipal grids supply alternating current, or AC, but silicon chips inherently run on direct current, DC.
So in a legacy data center, that power has to be converted from AC to DC and step down in voltage multiple times before it actually reaches the server rack.
And every single time you convert or step down that power, you experience joule heating. You lose a percentage of that electrical energy entirely as waste heat.
It's like trying to fill a water balloon with a high-pressure fire hose. You're going to lose most of the water splashing out during the transfer.
Exactly. It's incredibly inefficient. So by transitioning the entire facility to an 800-volt DC architecture, they minimize those conversion steps.
Which drastically reduces the energy lost as waste heat. And Ruiz said this improves overall facility electrical efficiency by roughly 5%.
Now, 5% might sound marginal to a layperson, but a 5% efficiency gain on a 1 gigawatt site is monumental.
That's millions of dollars in annual electricity savings.
And more importantly, it allows more of the facility's total power envelope to be dedicated to actual AI processing, rather than just spinning cooling fans.
So to win this 800-volt transition, Ruiz outlined his 4 blocks to win.
Right. If you want to be the prime power contractor for a hyperscaler, you must master 4 distinct technical blocks.
Number 1, medium voltage solid-state transformers, which are vastly more efficient than the old iron core ones.
Number 2, core DC breaker technology. Managing and interrupting high-voltage DC without creating massive electrical arcs is really difficult engineering.
Number 3, power electronics and power quality, mainly massive uninterruptible power supply systems, the UPS.
And finally, number 4, thermal management, cooling.
And what's fascinating is Eaton didn't try to organically develop all of this in-house over a decade. The AI boom is happening right now.
So they went out and aggressively bought the best pure-play companies on the board. For the transformers, they bought Resilient Power.
But the crown jewel, the one that completely solves block number 4, was acquiring Boyd.
Boyd specializes in advanced liquid cooling, specifically direct-to-chip cold plates and cooling distribution units.
Because these next-gen AI chips get so hot, traditional HVAC systems pushing chilled air just physically cannot displace the heat fast enough.
The silicon would literally melt. You require chilled liquid flowing directly over the chip packaging to pull that heat away.
And Boyd is the undisputed market leader in this, and the financials validate that immediately. In Q2 alone, Boyd generated $432 million in revenue,
which was a full 20% above Eaton's internal expectations. They subsequently raised Boyd's full-year revenue expectation to $1.8 billion.
That is a huge leap from the $1.1 billion Boyd did last year as an independent company.
But, you know, the true strategic value of Boyd isn't just selling cold plates at a high margin. Boyd is a foundational design partner for the major semiconductor manufacturers.
Right, because thermal dynamics now dictate how powerful a chip can physically be. The chip makers have to bring Boyd to the engineering table while the silicon is still in the blueprint phase.
And because Eaton now owns Boyd, Eaton gets a seat at that highly restricted table.
They get an early proprietary look at the thermal roadmaps for chips that won't hit the market for another 3 or 4 years.
It creates an unbelievable synergistic advantage. Eaton can preemptively design the entire electrical ecosystem, the transformers, the breakers, the UPS specifically tailored for chips that don't officially exist yet.
It gives them a complete grid-to-chip portfolio.
Yeah.
From the municipal utility substation all the way down to the cooling plate on the silicon die.
And that is the moat Paulo Ruiz emphasized. If a rival megacap industrial wants a piece of this trillion-dollar TAM, they might try to buy a cooling startup.
But Ruiz's point is that cobbling together disparate parts isn't enough.
You need all 4 of those technical blocks, fully integrated, plus a massive, rapid global service network.
Because if a Microsoft data center has a power anomaly, they aren't going to call 4 different vendors and wait 3 days to see whose equipment failed.
They demand a single throat to choke, a unified system, and a service tech on site in 1 hour, anywhere on Earth. If a competitor lacks even one piece, no solid-state transformers or no global service, they can't package the solution.
Eaton has painstakingly assembled the whole package, and they made another brilliant under-the-radar acquisition, FiberBond.
FiberBond is huge. They provide prefabricated, modular data center structures.
They physically build these complex electrical rooms inside a factory, load them on a truck, and drop them fully assembled onto the site.
Which solves the most critical physical bottleneck in the supply chain, the severe shortage of specialized labor.
Right. Ruiz noted there's a massive shortage of master electricians and pipe fitters capable of doing this complex stick-build construction on site in the mud.
You literally cannot find enough humans to wire up 307 gigawatts manually. So Eaton bypasses that bottleneck. They build it in a pristine factory and ship it as a plug-and-play module.
It compresses the commissioning timeline by months. It's just brilliant capital allocation.
And this leads us into part 5. Having the best technology is useless if your own manufacturing footprint can't scale fast enough.
Right. The execution and the capacity ramp. Rapid exponential growth is actually incredibly dangerous for a legacy manufacturing company.
It's like a snake swallowing a massive alligator. The danger isn't catching the prey, it's the digestion phase.
If your internal systems can't process the volume, you choke. You fracture your supply chain, you pay massive premiums for raw materials, overtime goes through the roof.
Quality control plummets, and ironically, profit margins completely collapse, even while top-line revenue skyrockets.
But Eaton is currently executing a $1 billion capital expenditure capacity expansion. 24 major manufacturing projects coming online simultaneously in the Americas alone.
And the operational metrics show they are digesting it exceptionally well. Ruiz stated they've increased total revenue processed per day by roughly 25% since the start of 2024.
25% more heavy equipment manufactured and shipped every single day than 18 months ago.
And the transition from Q1 to Q2 was their single largest sequential quarterly ramp in production output in their entire modeling history.
The moment of maximum danger. Yet they cleared the hurdle flawlessly. And crucially, they actually expanded their profit margins while doing it.
They did not sacrifice profitability for sheer volume.
A lot of that goes back to the cultural shift Paulo Ruiz is driving. He emphasized moving away from a rigid top-down bureaucratic structure.
You have to empower the 100,000 employees on the ground. A CEO in a boardroom can't micromanage a supply chain hiccup when you're standing up 24 new factories.
You need the local plant managers solving problems autonomously. And you could actually see that leadership culture on the call itself.
Oh, the shout out to Dean Dre. That was a great moment.
Yeah, right in the middle of outlining $1 trillion TAM, Ruiz completely pauses the presentation to personally congratulate an RBC capital markets analyst, Dean Dre, on his 30-year career in retirement.
He thanked him for his candor, his rigorous modeling, his tough questions over the decade.
He just projects such a highly confident management team. They are culturally dialed in, maintaining professional grace even under the massive pressure of a $1 billion manufacturing ramp.
It subconsciously signals to Wall Street that leadership is firmly in control.
So, with that Q1 to Q2 production ramp safely cleared, let's look at part 6. Management guidance. What are they broadcasting for the rest of 2026?
Well, because they cleared that hurdle without fracturing margins, they confidently raised guidance across virtually every metric.
Full-year EPS guidance revised upward by 22 cents to a new midpoint of $13.50.
Organic growth bumped up by 200 basis points to 11% to 13% for the year.
America's up to 15%, and Electrical Global saw a massive 450 basis point upward revision to 12%.
And we already mentioned Boyd being raised to $1.8 billion. But the vital piece for investors modeling future cash flows is what CFO Dave Foster called the margin walk down.
Right, projecting profitability accelerating significantly in the back half of the year. He said overall margins will jump by an astounding 450 to 500 basis points from the first half to the second half.
He broke that down mechanically. 300 basis points comes from price-cost normalization.
Okay, unpack that. Because they were frantically standing up factories and hiring labor earlier in the year, their internal costs spiked, right?
Yeah, they had to temporarily absorb those costs to keep production moving, which compressed margins slightly. But they simultaneously executed strategic pricing actions, raising prices for end customers.
And it naturally takes a few months for those higher price contracts to flow through the backlog and hit the bottom line.
Exactly. So now in the second half, those price hikes have fully caught up to the inflationary pressure. The temporary costs normalize, but the higher structural pricing remains permanently locked in,
resulting in a pure 300 basis point expansion to the profit margin.
And the remaining 150 to 200 basis points is pure factory productivity and operational leverage.
Because during the scale-up, they were running highly inefficient, expensive overtime shifts. Thousands of new, inexperienced workers.
Slower throughput, higher defect rates. But entering the second half, those factories are fully scaled.
Running on standard time, experienced workforce, optimized logistics. The cost to produce every single widget drops significantly.
Which means Q3 margins are projected to jump 250 basis points from Q2 alone, strictly because the physical factories are finally humming.
And they even planted a flag for a long-term goal. A 32% margin exit rate by 2030. They have a dual engine of profitability.
Leveraging market dominance for higher prices and utilizing massive scale to lower production costs.
An analyst actually asked if hitting those margin targets was dependent on sustaining this hypergrowth. And Foster said the margin expansion is largely structural now.
Right. Removing premium overtime is a permanent cost reduction. The price increases are contracted in the backlog. They've engineered a deep margin of safety.
Which brings us to part 7, the bottom line. When we synthesize all this data, a very clear narrative emerges for the retail investor.
Let me give you one singular defining metric. In the entire decade prior to this infrastructure boom, Eaton managed to add roughly $1 billion to their total top-line revenue.
They were stagnant.
But from the start of 2024 through the end of 2026, a 3-year window, they are mathematically on track to add a staggering $10 billion to their top line.
From $1 billion over 10 years to $10 billion over 3 years. That is a company fundamentally transforming its identity.
Catching lightning in a bottle, they are the ultimate premium picks and shovels play for the AI boom. The verdict is strongly bullish.
Eaton is no longer a sleepy switchgear company. They are a mission-critical technology partner for the AI revolution.
So for the investor, what is the actionable takeaway?
The broader market is obsessed with buying the processing power of AI, like NVIDIA, betting on the brains of the operation.
But buying Eaton is betting on the central nervous system.
The massive, unglamorous physical infrastructure required to keep those multi-million-dollar brains from literally melting down.
And you get built-in diversification. If the AI hype cycle cools down and hyperscalers pause, Eaton won't collapse by 60% like a pure-play tech stock.
They still have a thriving aerospace business, commercial business, and utility grids that desperately need modernization regardless of AI.
It's direct, leveraged exposure to a megatrend, entirely backstopped by industrial-grade downside protection.
The core takeaways are undeniable. 14% pure organic growth, perfectly positioned for a 15-year, 307-gigawatt backlog, flawless factory execution, and raised guidance across the board.
One of the most operationally robust quarters in the entire industrial sector this year.
Which leaves us with one final, slightly provocative thought to mull over. We talked about how the Boyd acquisition puts Eaton at the design table with top chip makers right now.
Analyzing thermal output and power draw for silicon that the public won't see until 2028 or 2029.
They possess a direct line of sight into the physical future of computational hardware.
A legal operational crystal ball.
Exactly. So if Eaton's privy to those classified chip designs years in advance, how might a savvy investor utilize Eaton's future capital expenditures as a leading indicator?
Oh, tracking where they build their next modular factory or what kind of advanced thermal startup they acquire next?
Yes. Using Eaton's moves to figure out where the trillion-dollar AI hardware sector is heading, long before the chip makers ever make their public announcements.
That is a fascinating angle.
Think about that the next time you see a 112-year-old heavy metal company outperforming the fastest tech stocks on the market. Thank you for joining us on this deep dive into Eaton Corporation. Keep looking past the simple tickers, keep reading the transcripts, and we will catch you next time.